Welcome to this explainer. Today, we are diving into what I like to call the ultimate accounting mystery. We're going to figure out exactly why your business's cash records almost never match the bank's records, and more importantly, how to fix it. If you've ever stared in total frustration at two completely different numbers that are supposed to represent the exact same pile of money, well, you are definitely not alone. By the end of this, we're going to completely master the bank reconciliation statement. We're going to unlock that conceptual clarity you need, not just for real-world business, but to totally ace your accounting exams.
Here is our roadmap for today. We'll cover the two books, the Golden Mirror Rule, why balances disagree, the BRS solution, step-by-step reconciliation, and finish up with an exam recap and takeaways.
Section 1. The two books. Who is tracking the money? Let's build our foundation. You know, with the massive volume of trade and commerce happening today, trying to deal strictly in physical cash, it's pretty much impossible. Businesses have to rely heavily on banks. And because of this setup, we end up with two completely independent sets of records tracking the exact same funds. On one side, we have the cash book. Now, this is maintained by the account holder, so that's you, or your business accountant. On the other side, we have the passbook, which you might know as the bank statement, and that's prepared and maintained by the bank. Theoretically, the balances in both of these books should be absolutely identical at any given millisecond.
Moving to Section 2, the Golden Mirror Rule, equal and opposite.
All right, here is the absolute core logic of banking, and honestly, it's where so many students lose marks. We're going to call it the mirror memory trick. The balances in these two books are equal, sure, but they are completely opposite in nature. Think about it like this. If you deposit 1 lakh rupees into your bank account, that's a receipt for you, right? So you record it as a debit balance in your cash book. But from the bank's perspective, they just received a pile of money that belongs to you. It's actually a liability for them because they literally owe it back to you. Therefore, they record it as a credit entry in your passbook. This beautifully illustrates how the gears of commerce actually turn. This mechanical relationship only functions because both sides are meticulously recording the exact same financial flow, just from reverse perspectives. Your asset is their liability, and vice versa. So whenever you get confused on a test or in real life, just remember to look in the mirror.
Which brings us to Section 3, why balances disagree, the disconnect. So if they are perfect mirrors of each other, why is there a problem to begin with? Well, the crucial point here is that most of the time, these two balances do not magically match. The culprits causing this disconnect always, and I mean always, fall into one of two clear categories: timing differences or errors. Errors are exactly what they sound like: mistakes made by either the bank or the customer. This could be, omitting a check entirely, recording an entry on the wrong side, or just plain old bad math when totaling the account. Now, a bank rarely makes these errors, but when they do, or when your accountant slips up, the balances are going to diverge.
But timing is the biggest factor by far. Sometimes a single transaction is simply recorded at two different times. There's almost always a lag, a delay between an action happening in your office and the reaction occurring at the bank. Let's look at how this plays out in the real world.
Picture this timeline. You pay a supplier today by issuing a check. The very second you hand over that piece of paper, your accountant records the payment. Boom! Your cash book balance immediately drops. But wait, the bank has absolutely no idea this just happened. The supplier might sit on that check for a few days before presenting it to their bank, and then it takes even more time for the funds to actually clear the system. Your passbook balance won't drop until that final step happens. During those intervening days, if you compare your cash book to your passbook, they are going to violently disagree. Other timing differences include things like bank charges deducted directly by the bank or direct deposits from customers, which you only find out about after the fact.
And that leads us to Section 4, the BRS solution, bringing harmony to the ledgers. So how exactly do we fix this mess and find the true position of our cash? We use a super powerful accounting tool called the Bank Reconciliation Statement, or BRS. The BRS is simply a statement that reconciles the bank balance as per the cash book with the balance as per the passbook by mapping out all the causes of the differences. But listen, it's way more than just doing math. It's basically a real-world detective tool. It actively highlights hidden accounting errors. It spots undue delays in the clearance of checks, letting you know if your funds are stuck somewhere, and crucially, performing a regular reconciliation strongly discourages an accountant from attempting embezzlement or fraud simply because discrepancies get caught so quickly.
Let's get practical now in Section 5, Step-by-Step Reconciliation, Solving the Mystery. Let's walk through the actual logic here. And please, the biggest mistake students make is blindly memorizing formulas. Don't do that. Instead, use what we call the target book logic. Step 1, you just start with a balance of one book, let's say the cash book. Step 2, you compare the statements side by side and find the unticked entries, basically the items that appear in one book but not the other. Step 3, your sole overarching goal is to adjust your starting balance to match exactly what the target book currently says. Step 4, you arrive at your reconciled balance.
Let's apply this to a real example directly from our source material to make it concrete. Imagine you're reviewing your accounts for May. You spot an unticked entry. You wrote a check to Mr. A for 30,000 rupees. Now, because you wrote it, it's obviously recorded in your cash book. You subtracted 30,000. But when you look at the bank's passbook, that entry is nowhere to be found. It just hasn't cleared yet.
Okay, active recall time. I really want you to think about this for a second. We are starting with our cash book balance, and our mission is to reconcile it to match the passbook's current reality. In your cash book, you already subtracted the 30,000, so your book shows less money. But the bank hasn't subtracted it yet. To make your cash book mathematically match the bank's current, technically inflated number, what must you do?
You've got to add it back. Since the passbook balance hasn't dropped yet, you have to temporarily reverse your own deduction by adding that 30,000 back to your starting cash book balance. Now, to be clear, you aren't changing your actual permanent accounting records here. You're just building a temporary mathematical bridge to prove why the bank statement says what it says. Grasping this match the target book logic, that is exactly how you master reconciliation effortlessly without ever having to memorize a single formula.
Finally, Section 6. Exam recap and takeaways. Let's lock all these concepts in.
If you're a student prepping for an exam, this summary is absolute gold. Screenshot this if you need to. It perfectly lays out exactly when one book's balance outpaces the other. Your cash book balance will be greater than the passbook when you deposit checks that haven't cleared yet. You counted the money, but the bank hasn't. Conversely, your cash book balance will be lower than the passbook when you issue checks that haven't been presented yet, or, say, when the bank quietly adds interest to your account that you just haven't recorded on your end.
And never ever forget that mirror trap we discussed earlier. Examiners absolutely love to test this vocabulary. A debit balance in your cash book means you have positive deposits. Great. But a credit balance in your cash book? That means you are overdrawn. Now, flip over to the passbook. A credit balance there is fantastic news. It's a positive deposit. But a debit balance in your passbook? That's an overdraft, meaning you owe the bank money.
Ultimately, understanding this stuff isn't just about passing exams, it's honestly about basic financial literacy. Remember the core takeaways. Your books are mirrors, timing differences are usually your main suspects, and your only goal when reconciling is to mathematically match your target book. It helps you find the true position of your money, ensuring every single financial transaction is totally accounted for. So, armed with the detective logic of the bank reconciliation statement, what mysteries, unticked items, or maybe even hidden fees might you find if you audited your own personal bank account today? Might be time to take a look in the mirror. Thanks so much for joining me for this explainer, and hey, happy reconciling.
Let's dive right in. Welcome to The Explainer, where today we're basically becoming financial detectives to solve the ultimate accounting mystery, missing money. Have you ever looked at your own personal records, thought you had plenty of cash, and then checked your bank app only to see a completely different, usually lower number? Yeah, it's a sinking feeling, right? Well, in the business world, this happens literally every single day. So today, we're going to master the tool that solves this exact problem, the Bank Reconciliation Statement, or BRS. Whether you're a business owner trying to protect your hard-earned cash or a student looking to secure maximum marks on your exams, understanding this concept is absolutely vital. Okay, here's our roadmap for today. We'll cover 1. The bank reconciliation mystery. 2. Why balances don't match. 3. Method 1. Direct reconciliation. 4. Method 2. Adjusted cash book. 5. Solving real exam problems. And finally, 6. A final recap and revision tips. Let's start with Section 1, the bank reconciliation mystery. So we kick things off with a core conflict. Why does the money you think you have not match what the bank says you have? It's really a tale of two different books. On one side, you have the cash book. That's the record you or your accountant maintains. On the other side, you have the bank passbook, which is the official record the bank keeps. A BRS is our primary detective tool here. It's simply a statement that lists out every single reason why the balance in your book doesn't perfectly match the bank's book on a specific date. Now, to really grasp this, we need to talk about the mirror analogy. This is the absolute foundation of all BRS logic. And honestly, it's where beginners get tripped up the most. In your cash book, money in the bank is an asset, which is a debit. So when you receive money, you debit your account to show more money. But think about it from the bank's perspective for a second. When you deposit money with them, the bank now owes you that money. To the bank, you are a liability. Therefore, when your bank balance goes up, the bank actually credits your passbook. Remember this golden rule. Your debit is their credit, and your credit is their debit. They are perfect mirrors of each other. Moving on to Section 2, why balances don't match. Now that we understand the whole mirror concept, let's look at the usual suspects causing these mismatches. I want you to remember a simple acronym, TTE. That stands for timing, transactions, and errors. First up, timing differences. Say you write a check to a supplier today and immediately subtract it from your cash book. But what if they don't cash it for 2 weeks? The bank hasn't subtracted it yet. Second, transactions you just didn't know about yet. Think of direct bank charges or an auto-renewal for a subscription like Netflix. And third, plain old errors. Maybe you accidentally wrote down 54 instead of 45. It happens to the best of us. This part is actually super interesting because it's not just dry accounting theory. This is exactly how you stop fraudsters from hiding stolen cash. The source material explicitly points this out. If a shady cashier simply makes fake entries in the cash book but physically pockets the cash instead of depositing it, a regular reconciliation will immediately sound the alarm because the bank passbook will show that the deposit never actually arrived. It is an incredibly powerful internal control mechanism. All right, Section 3, Method 1, Direct Reconciliation. Let's look at our first actual solution technique, which is reconciling without touching our original accounting books. Now, instead of blindly memorizing a massive, stressful table of rules, I'm going to give you a shortcut. Just use the target book trick. Ask yourself what the target book did, and literally just copy that action. You'll always be given a starting balance, let's say your cash book. Your goal is to reach the target balance, the passbook. Don't stress about memorizing whether to add or subtract, just look at the target. If the target went up, you go up. If the target went down, you go down. Let's see exactly how this works in action. Okay, so if you start with a cash book, the passbook is your target. Let's take a check issued but not presented. You already subtracted it in your cash book when you wrote the check, right? But has the bank, our target, subtracted it yet? Nope, because the supplier hasn't presented it. Since the target passbook is still higher, you must add it back to your starting balance so you match them. Make sense, right? Conversely, what about bank charges? The target passbook has already subtracted them. You haven't done that yet. So what do? You subtract them to match the target. It really is that simple. On an exam, they're going to give you one of 4 starting balances. You might start with a favorable debit balance in the cash book, an unfavorable credit overdraft, or their passbook equivalents. But don't panic. No matter where you start, just carefully apply our target trick step by step, and you will effortlessly arrive at the correct final balance. Identify the discrepancy, ask what the target book did, and adjust. If your final calculated number matches the actual balance of that opposite book, well, congratulations, you just solved the mystery. Now for Section 4, Method 2, Adjusted Cash Book. So what if we want to be a bit more accurate and actually fix our own messy records first? If we were doing this reconciliation at the very end of the financial year, we absolutely have to reflect the true bank balance in our balance sheet. The direct method is totally fine for a quick mid-month check, but at year-end, if your cash book is full of silly errors or missing bank charges, you have to correct your own accounting records first before building the BRS. And that brings us to Method 2. Think of the adjusted cash book method like a filter. With the direct method, you just dump every error, every missing transaction, and every timing delay into one giant statement. But the adjusted cash book method is a much cleaner 2-step process. Step 1. You open your cash book back up and fix anything that was our fault or anything we just didn't know about yet. Step 2. You create a much shorter BRS that only contains the things that are totally outside of our control, which are primarily timing differences. If you're studying for an exam right now, literally write this golden rule down. Take a mental picture of it, memorize it, because mixing up what goes in the cash book versus the final BRS is exactly where students lose the most marks. If you made a math error, fix it in the adjusted cash book. If the bank charged you a sneaky fee and you didn't know, record it in the adjusted cash book. But if you deposited a check and the bank is just taking 3 days to clear it, you could not fix that in your cash book. That is a pure timing delay, and it is the absolutely only thing that belongs in the final bank reconciliation statement under this method. Section 5. Solving Real Exam Problems. Okay, let's put our detective hats back on and solve some actual case files from the source material. Take Mr. Gadbodwala, for instance. His books were a complete mess, but by patiently fixing his errors first, the timing differences practically solved themselves. In this specific illustration, his payment side was undercast by 10,000 rupees. That's just a simple math error. According to our golden rule, that goes straight into fixing the adjusted cash book by crediting it. Only after we clean that up do his unpresented checks move to the final BRS. And then we have the Nikki & Co. case, which highlights some absolutely brilliant exam traps. Let's look closely about last bullet point. An out-of-date check returned for 11 lakh rupees. If a check is returned because it's too old, the bank cancels the deposit. But if you didn't know that happened, your cash book still thinks you have that 11 lakh rupees. That is an omission. You have to go into your adjusted cash book and credit it to remove that phantom money before you even think about starting the final BRS. Finally, Section 6, Final Recap and Revision Tips. Let's lock all this in so you are fully prepped to completely dominate this topic. Whether you are hunting down errors or stopping embezzlement in its tracks, the BRS is your ultimate truth teller. Always remember our TTE culprits: timing, transactions, and errors. Remember that you can start from any of the 4 balances using the target book trick. And most importantly, remember, you have 2 distinct methods at your disposal, depending on whether or not it's the end of the financial year. Seriously, take a mental screenshot of this matrix right here. It perfectly summarizes how timing differences, like an unpresented check, always stay in the BRS no matter which method you use. If you use the direct method, everything is just thrown into the BRS blender. But if you use the adjusted cash book method, you sift out your own errors and omissions first, leaving only the unpresented and uncleared checks for the final reconciliation. Keep this logic straight in your head, and you will never get confused on an exam question again. I want to leave you with this final thought. Mastering the bank reconciliation statement isn't just about passing an exam. It is about total transparency. It highlights bank delays, it keeps your internal records honest, and it protects every single penny of your hard-earned cash. So the next time your balances don't match up, don't panic. Just pull out your Tarka book trick, apply those golden rules we talked about, and solve the mystery. Because if you aren't reconciling your books today, how much missing money is slipping right under your nose? All right, let's just dive right into this. Welcome to our comprehensive explainer on mastering the bank reconciliation statement, or the BRS. Now, if you're an accounting student, or you're prepping for a professional exam, or maybe you're just running a small business, you probably know this topic can sometimes feel like, well, a really dry accounting chore. But today, we're going to completely transform it into a highly intuitive, logical detective process. Seriously, you aren't just crunching numbers here. You are essentially a financial detective, and your job is to search for the truth between 2 very different sets of records. So we have a super packed agenda for today. We'll kick things off with a quick intro to bank reconciliation, figure out the actual causes behind those balance differences, and then lay down the golden rules of BRS. After that, we'll tackle some common exam adjustments, solve a few practical problems together, and finally wrap it all up with a solid recap and some exam tips. Let's get to it. Starting right off with Section 1, an intro to bank reconciliation. Let's tackle the most basic question every accounting student faces at month end. Why don't your cash book and your bank statement ever actually match? Well, it's pretty much a universal truth in business that your books and the bank's books are rarely going to show the exact same number on the very last day of the month. Just imagine your company's cash book and the bank's passbook as 2 diaries, right? And they're both trying to record the exact same financial events. Inevitably, one diary is going to get updated way before the other one does. Say you write a check to a supplier on Tuesday. Bam, you immediately deduct it from your diary. But the bank? They don't know a thing about it until that supplier actually cashes it on, say, Friday. So during that 3-day window, your diaries are totally out of sync. And that brings us to our main tool, the Bank Reconciliation Statement, or the BRS. Think of the BRS as our master detective's ledger. It's basically a snapshot prepared on a very specific date to track down that missing money and explain exactly why those balances are differing. By doing this, we're ultimately proving that both diaries are actually completely mathematically correct from their own unique perspectives at that exact moment in time. Moving on to Section 2, let's look at the actual causes of these balance differences. According to our source material, we can actually categorize every single discrepancy into one of 3 main culprits. First up, we've got timing differences. These happen when transactions get recorded in different periods, like that check you issued that the recipient just hasn't bothered to cash yet. Second, we have direct transactions. These are actions initiated by the bank directly, without your immediate knowledge. Think of things like surprise bank charges, or maybe a tenant directly depositing rent right into your account. And finally, errors. I mean, human mistakes happen, right? Whether it's the bank debiting the wrong account entirely, or the accountant overcasting, which, by the way, just means accidentally adding up a column to a higher total than it really should be. These three categories are literally the root of all your BRS mysteries.
All right, Section 3. Before we solve any problems, we absolutely have to establish the golden rules of BRS.
So, the absolute foundation of a BRS is understanding this inverse relationship. A favorable debit balance in your cash book is the exact same thing as a favorable credit balance in the bank's passbook. Why? Well, because the money in your bank account is an asset to you, right? Hence, a debit. But to the bank, your money is actually a liability that they owe back to you, hence a credit. So here's a quick memory trick for your exams. Your debit is their credit. Both just mean you have positive cash. Overdrafts are the exact opposite. That's a negative, sad situation for everybody.
Okay, let's introduce a completely foolproof problem-solving technique for exams. We call it the baseline method. Step 1, identify your starting point. Let's just say it's your cash book balance. Step 2, you look at the destination book, which is the passbook, and you ask yourself, okay, what did the bank do? And then step 3, you simply adjust your starting point to mimic whatever the ending book says. It's essentially a game of follow the leader. Whatever that destination book did, your starting book has to copy. Let's test this out in Section 4, Common Exam Adjustments. Here is a classic scenario that honestly traps students every single year. You issue a check. So what happens? Following our baseline method, Step 1. Your cash book balance drops immediately because, well, you recorded the payment. But Step 2, the bank hasn't actually seen this check yet, so their passbook balance stays high. Now for Step 3, if your starting point is the cash book and your goal is to mimic the passbook, you have to reverse your initial action. You literally have to add that amount back to your cash book to make the balances match. Make sense?
Let's dive into a bit of a cheat sheet for those high-yield exam traps. Assuming you're starting with a favorable cash book balance, just remember how these specific adjustments work. If the bank charged you a fee, that means the destination book lowered the balance, so you have to mimic them and deduct it too. What if a customer made a direct deposit? Well, the bank increased the balance, so you add it. Simple enough. But now let's think about overcasting the credit side. The credit side of your cash book records payments. If you accidentally overcast or overcalculate your payments, you have artificially lowered your cash book balance. To fix this mistake and reconcile with reality, you have to adjust it back up or down depending on your starting point. You've got to keep this logic tight.
All right, Section 5. Let's put our detective hats on and solve some practical problems. Before we start crunching numbers, here is an absolutely critical exam rule explicitly stated in our sources. Adjusting the cash book is not just a suggestion, it's actually mandatory when preparing your reconciliation at the end of the financial year. You literally have to fix human errors like undercasting and record direct bank transactions like dividends in your cash book first. Only after your cash book is fully updated do you go ahead and create the final BRS to deal with those lingering timing differences like your uncleared checks.
Let's look at the GOPI problem from our sources to see this mandatory adjusted cash book step in action. So we start with the original flawed cash book balance of $44,500,000. But wait, we uncover some unrecorded bank receipts. So we add those missing dividends and rent, which total $640,000. Then we deduct the missing payments and correct our errors, totaling $174,500. Doing this math gives us our true, correct starting point for the final BRS, an adjusted cash book balance of $49,115,500.
Now let's tackle a more complex practical problem using the plus and minus format, but this time let's start from the passbook. If we start with a passbook balance of $10,000, our goal is to mimic the cash book, right? This means we have to think entirely backwards. We add items the cash book falsely thought were receipts, like checks deposited but not yet cleared. Conversely, we must deduct the checks the cash book issued, even if the bank hasn't paid them out yet, simply because we have to follow the cash book's lead.
So, after carefully applying our baseline rules to every single line item from that scenario, we add up the plus column, subtract the minus column, and boom, we perfectly arrive at the final reconciled cash book balance of $16,090,000. It is honestly incredibly satisfying when all those financial puzzle pieces finally just snap together perfectly.
Okay, we made it to Section 6, our recap and final exam tips.
You'll definitely want to lock in these memory tricks for your final revision. First up, the baseline method. Always adjust your starting book to mimic the destination book. Next, dealing with an overcast, just remember, overcast credit means you over-recorded payments, overcast debit means you over-recorded receipts. Next, uncleared checks. If you start with the cash book, always deduct deposited checks that haven't cleared yet. And remember that golden rule we talked about. At year-end, the adjusted cash book is absolutely mandatory. Finally, if you're ever lost when comparing two statements line by line, just look for the unticked items. Those are literally always the source of your differences.
So we'll end on this somewhat provocative thought. Could a simple BRS actually save a company from massive funds embezzlement? The answer is absolutely yes. Because as our sources explicitly note, regular reconciliation is essentially the ultimate defense against accountants temporarily misutilizing funds. By mastering this, you aren't just a student passing an exam. You're becoming a vital financial protector for any business. Keep practicing those rules, and I'll see you in the next explainer.